Well, Old Mutual reporting, as I said, a 15% rise in its first half profit. Looking at the driving forces individually here, it's been helped by cost cuts on the one hand. And with that, we've had some market watchers concerned about the sustainability of this kind of growth moving into the second half. Is there enough growth in the business itself to support this growth moving forward?
Yes, I think there is. We're very pleased with the 15% uplift in the first half of this year. Clearly, with the global markets very volatile at the moment, that will have an impact on the second half if there isn't a bounce back. But we're pleased with the state of the company.
Let's look at another force that's come to play here. I mean, this time a real emphasis being placed on the strong growth coming through from your South African operations. That's Old Mutual South Africa, Nedbank, Mutual and Federal as well. What's your assessment of the South African financial landscape at the moment, where things are still tough? We've got loan growth, still a struggle for one within a very challenging economic environment.
Well, I think our businesses are doing particularly well. You know, over the last couple of years, clearly we had the retail impairments in Nedbank, which are now easing off, allowing profit growth. I think if you go through to the Old Mutual business, that mass foundation cluster, that emerging population that are needing more and more financial services, we are very dominant in that area, and we see that growth continuing into the future.
That presenting some of the opportunity, where do some of the risks lie in your books?
Well, clearly, a good part of our remuneration comes on the level of assets. And, you know, if the markets carry on going down, then our remuneration will be lower. If people get worried about equity markets and therefore start moving into other types of products, if they move into cash, then particularly in our European business, that would give us less revenue.
So really a challenge, you know, sustaining some of that revenue that you've enjoyed over this half there. You've said that you're in no hurry to offload Nedbank at this stage. It means that the timeline is questionable. Is it something that's still on the table, though?
Yes, our strategy is very clear. I want to focus the group very much on our long-term savings, our protection, our investment business. And so strategically, if you go into the long term, as I've been open, I don't see us as a majority shareholder in Nedbank. In the short term and in the medium term, you know, that's a different situation, and I'm very comfortable with Nedbank, the relationship with Nedbank, and what I think will be the growth prospects of Nedbank.
So when you say long term, what kind of timeline are we looking at there?
Well, that's really not in our hands. That's in the hands of the global markets. You know, right now investors are reducing their investments in banks, not increasing them. So to persuade a bank to that they should be investing in acquiring another bank is a tough situation. So you know, the banks around the world are having a tough time.
Well, we've unpacked some of the economic woes there. I mean, from a regulatory perspective, how do you see the recent requirements with regards to phase specifically impacting the business from here on out, where we've seen low pass rates coming through so far, leading to the argument that over the next 6 months, you know, we could be looking at a very challenging period for the group?
Well, clearly the FSB have extended the time for people to sit the exams. Clearly, for many companies, getting their staff through the exams is a tough challenge. It's early days yet. We have a disciplined approach, and we are confident that we will get our people through. But if they are tough exams, and therefore people will need time off work in order to get through them.
Let's shift focus to some of the regulatory environment over in Europe and how you're navigating there, where especially life assurers have needed to effect change from a broker distribution model to a tied agency distribution model, where you're going to have to employ those people who sell the product as opposed to pay them on a commission basis. What's your view on the impact that that's set to have on the business? Because ultimately it's going to impact costs, which you've been driving lower so far.
Well, the big difference that is coming through is that independent financial advisors won't be able to receive large upfront commissions, so therefore they move more onto fee, and people will be more on trail commission. I have to say, across Europe, this has been happening over a number of years. And most of the IFAs that we deal with in Europe are ready and are changing their model. So I don't believe that's going to be too much of a problem. We're seeing people change now.
Well, you've closed your Switzerland operations, and it certainly shows some discipline in pursuing profitable operations for growth. Have you earmarked any other operations that could go down the same path?
Now, you know, I'm not going to say anything about that until I've actually done it. I mean, Switzerland quite clearly was a good business, but it was small. And I have openly said that I want businesses to give good financial return, but need to make a meaningful contribution. And so that's why we decided not to close it to new business. All of my business heads know that they've got to produce good returns, they've got to produce scale, otherwise, you know, it might happen to them. But I won't go through the detail until...
Well, it was worth a try anyway, Julian. Now let's move on to where you're seeing the growth potential then, because given that a lot of growth has come through from South Africa, are you, happy with the kind of expansion you're seeing in terms of expanding your emerging market exposure, diversifying from your dependence on South African operations?
Yes, our strategy is, I believe, working really well. We've moved our Latin American, our Far East emerging market operations to be run by our South African base. So now all of the emerging markets, South Africa, Africa, Latin America, Far East, are all managed by the team and people from Kuseni. And what that means is we do believe that those markets are similar, and therefore we can leverage the capability, the skills, most importantly, the products that we have in South Africa and across emerging markets. So I am looking forward to growing the franchise that we have. I'm looking forward to looking for opportunities to grow in Africa, and I think it's exciting times.
Well, while that is what emerging markets potentially brings to your portfolio from here on out, you've said that exposure to, the PIGS nations over in Europe is low, yet your bond portfolio in Bermuda has seen a credit rating deterioration. What's that being attributed to, and to which sovereigns have you been exposed?
Well, we've had very little exposure, as we've said before, to the European government debts. That seems to be an issue for many of the European banks, but largely not for insurers and not for ourselves. Bermuda and the Bermuda issue is more about the volatility of global markets and the volatility of global assets. So we're not particularly caught with bond markets, but we're more caught by the ratings of the countries in which people have invested through our Bermuda operation.
Just moving on to another aspect of the business, you've delayed the listing of the local Old Mutual Triangle Property Fund and the US asset management business as well, where investors have really been waiting for that breakup to unlock further value moving forward. Just how much longer will they have to wait? Can you offer any guidance on that front?
Well, I think the most important thing, most of our investors, most of the market believed that we had to do the partial IPO of US asset management in order to meet our our debt retirement target, our $1.5 billion debt reduction. What we said clearly today is that isn't the case. We went through in our press release and showed that we can hit our 1.5 debt reduction target without the IPO. And the most important thing of that is that means that we are not going to be forced to try and do an IPO of a business when it isn't ready. If we did that, we would lose shareholder value by doing so. So now we will keep working with the US asset management business. We'll keep on working to improve investment performance, improve margins, improve growth. And when we have got that right, then we will go and do the IPO.